This is Nightly Business Report with Sue Herrera and Bill Griffin.
Tough tariff talk. Stocks come under pressure on renewed concerns of a trade war, and a lot of companies could be in the crosshairs.
Turbulence at United. The airline is in the news again. But is the real problem the carrier's corporate culture?
Savings gap. Oregon is trying to help close that, becoming the first state to help workers save for retirement. Those stories and much more tonight on Nightly Business Report for this Wednesday, March the 14th.
Good evening, everyone, and welcome. One of the biggest issues looming over the stock market is the risk of a trade war. Today, that issue bubbled to the surface. The Commerce Department signaled that a few product exclusions to the tariffs would be granted to U.S. companies, and that prompted some of our allies to say that they could impose their own trade measures if necessary. The Dow Jones Industrial Average fell 248 points to 24,758. The Nasdaq was off 14, and the S&P 500 dropped 15. Boeing was the hardest hit Dow stock following a report that the plane maker was a prime target for China to retaliate against.
As we reported last night, there is talk that the White House is considering tariffs on up to $60 billion of Chinese goods. Not surprisingly, that's not going over well in China. Eunice Yoon reports for us from Beijing.
The Chinese reaction today was a reiteration of comments and themes that the authorities have been touching upon in recent weeks as a trade war looms. At a regular press briefing, the Foreign Ministry said that U.S.-China trade relations should not be a zero-sum game. The ministry has made similar statements in the past. There was also a commentary in the official state news agency Xinhua blaming the U.S. for the apparently large trade deficit, saying the U.S. statistics are faulty, and said if Washington wants to narrow the trade deficit, it should ease restrictions on high-tech exports. That's another long-standing position that the Chinese argue. Yet another theme, the Chinese Statistics Bureau said today that the tariffs wouldn't hurt China much because the Chinese could sell to themselves. The Bureau was trying to calm some public concerns. And there are concerns that President Trump's tariffs could be expanded to include some basic Chinese goods, such as footwear, apparel, as well as toys. These exports are big employers here in China, and that's the reason why, despite the public pronouncement, what we're hearing on the ground is that the authorities here are concerned about a trade war, that they're frustrated with what they saw as lack of results after President Xi Jinping had sent his top man on the economy, Liu He, to Washington, and that they're drawing up their own list of American products to retaliate if necessary. For Nightly Business Reports, I'm Eunice Yoon in Beijing.
American companies are trying to figure out how the tariffs on steel and aluminum will impact their business. Kayla Tausche traveled to Middlebury, Indiana for that part of the story.
For each cargo trailer rolling off the assembly line at Look Trailers, 75% of it is comprised of U.S. steel and aluminum. The company's president, Matt Arnold, prefers domestic materials because they're higher quality and his business is highly regulated. With the new tariffs in effect, more competitors are shifting away from foreign steel, driving up demand and his costs immediately.
The abruptness and the nature of the way this is happening seems heavy-handed. We don't have the flexibility and the ability to raise capital. So it's very important for us that this not be so shocking, so strong.
The problem, Arnold says, tariffs go into effect next week, but shuttered mills could take up to 18 months to reopen and supply the market with the steel and aluminum it needs. Arnold says it's unsustainable.
There's a lot of uncertainty and a lot of apprehension. What we've seen is some competitors hold back, but we've had to move forward and we've had to raise prices. So we've got to do it immediately, and we're doing it as fast as we can.
The average trailer here retails for $3,500. That's up 9% from last year. Arnold's father raised prices 10 to 15% after the last steel tariffs, and the business suffered. Full-time employees were cut to just 3 days a week.
Arnold says at some point his industry will recover, but former Governor Mitch Daniels expects the negative effect on Indiana to be lasting.
We're the #2 auto state, the #1 RV state. major and with number one state in terms of manufacturing intensity, percentage of our whole economy that's involved in manufacturing. So even in Indiana, number one steel state, there is some real risk that the net of this could be negative, both in terms of simple job count and, of course, cost to consumers.
At Look Trailers, expansion plans on hold as it waits to see how the latest trade fight plays out. For Nightly Business Report, I'm Kayla Tausche, Middlebury, Indiana.
Now, if this trade fight becomes a trade war with China, there could be some winners and losers, and a lot of them. Keith Parker joins us now to share some of the names that he feels could be affected the most. He's U.S. equity strategist at UBS. Keith, thanks for joining us tonight.
Thank you.
Given our extensive trade relations with China, there are a lot of companies. I saw your research report. There are like 50 companies on this list here, and it's a good cross-section of all industries in the United States, right?
Yeah, I think we see the risk of rising tensions and sticker shock with 500 billion of imports from China. There's quite a lot that could play out, but we think the broad effect of a more broad tariff is unlikely. And what we're seeing now is potential talk of select tariffs on imports of consumer goods, other things that we import quite a lot from China, cell phones, tech hardware, semis, apparel, et cetera. And then I think there's the risk of the retaliation. So those companies selling in China or to China from U.S. and the export side. And so I think both of those types of companies may be at risk.
Yeah, we put together some of the names that are on this list, and as Bill mentioned, there are a lot of them. But there's really kind of an inordinate bias towards technology, which I think a lot of people would not expect.
Yeah, a lot of those tech companies have production in China selling to Chinese companies, and so there could be some risk there. But again, if this does escalate, there are chances potentially of Chinese, say, discouraging the buying of U.S. brands in favor of domestic production within China.
I mean, some of the chip stocks, for example, have been on fire here in the United States for a year or so. They could be affected by the Micron and others, right? Just to be specific.
There is that potential. I think the technology supply chain is very much intertwined and intertwined with China, and so the ties of trade definitely bind. But the semis story from a demand and a bit of a cycle and potential super cycle given demand from automation, virtual reality, et cetera, is there. But you do have that looming risk on the horizon where some of this China risk could be potentially discounted into these types of stocks.
As we take a quick look at some of these companies that are on your list, you cited Gary Cohn's departure as a worrisome factor. Now we know that Larry Kudlow is going to be going into that position, and he's a globalist, more of a globalist. Does that reassure you at all?
I think the market doesn't like change, and we'll hear what Larry has to say once in the post. I think that the market is worried about the rhetoric coming out of the White House currently, but there is some reassurance. We've heard Larry for years that the message that he was likely to deliver will be delivered clear and eloquently, and so I think that should be a positive for markets.
Keith Parker at UBS, thanks for joining us tonight, Keith.
Thank you.
Well, speaking of Larry Kudlow, as we just mentioned, he will replace Gary Cohn as the National Economic Council Director. Eamon Javers takes a look at how he might impact economic policy.
President Trump made the offer by telephone to Kudlow on Tuesday evening. Kudlow accepted, telling the president he would be honored to take the position. Kudlow comes to the job at a time when the president has been trending in a protectionist direction, talking about tariffs on China, tariffs on steel and aluminum imports into the United States. But Kudlow himself is an opponent of broad-based tariffs, and that sets up a fascinating tension between Kudlow and the president of the United States. I spoke to Larry Kudlow earlier today, and he told me that he believes that he'll be able to speak his mind freely about tariffs in this White House. But ultimately, he said, as the director of the National Economic Council, his job is to offer his advice. But once the president's decision is made, it's made, and Kudlow says his job will be to simply execute on it. Larry Kudlow comes to the job after a career at CNBC, where he was a television anchor and commentator. He's also served as an economist at Payne Weber and Bear Stearns on Wall Street. He served at the New York Federal Reserve and also at the Office of Management and Budget as part of the White House in the Reagan years. So Kudlow's got a lot of experience in Washington. One of the challenges will be this is a very different Washington than it was back in the 1980s. For Nightly Business Report, I'm Eamon Javers at the White House.
Meanwhile, a key economic report fell for the third straight month. Retail sales dropped 0.1% in February, dragged lower by reduced spending on cars and gasoline. It is just the latest report to suggest that the economy may not be overheating after all. In fact, following the release of that report, J.P. Morgan lowered its first quarter economic growth estimate to 2%, even from 2.5%.
It is time to take a look at some of today's upgrades and downgrades. Ford's rating was raised 2 notches to overweight at Morgan Stanley. It's Ford's first upgrade by the firm in almost 4 years. The analyst cites Ford's turnaround plan and the value of its F-150 franchise. The price target was hiked to $15. The stock rose 2% to $11.02. NVIDIA's price target was raised by 15% to $285 at RBC Capital. That firm says there are enough positives to drive the stock to new highs, like data center spending and gaming. The analyst maintains his outperform rating, and the stock rose a fraction to $248.74.
Sunoco's rating was cut to sell from neutral at Goldman Sachs. The analyst there cited headwinds for the company, including negative earnings revisions. Price target is at $28. The stock closed around that level at $27.68. And Century Aluminum's rating was raised to overweight from neutral at J.P. Morgan. The analyst cited the Trump administration's tariff on imported steel, which has prompted Century to increase its capacity. Price target was lifted to $29, but with today's sell-off, shares were down 5% at $20.45.
Still ahead, United Airlines makes headlines again, but is it the result of mismanagement or perhaps a poor corporate culture? Insider trading charges were brought against a former employee of Equifax. The ex-chief information officer allegedly sold almost $1 million worth of shares after learning of the data breach at the company, but before the company made that hack public. The breach affected 147 million individuals, and the company now faces more than 240 class action lawsuits.
The SEC today brought charges against the founder of Theranos, accusing Elizabeth Holmes of massive fraud. This is the same person, you'll recall, who was once compared to Steve Jobs and who became the first self-made female billionaire, at least on paper. Meg Terrell takes a look at Theranos' rise and fall.
Secretive startup Theranos was a Silicon Valley darling, garnering a private valuation of $9 billion in 2014. The company promised to revolutionize the blood testing industry, claiming it could perform a multitude of tests on just a single drop of blood. It was helmed by enigmatic founder Elizabeth Holmes, a young Stanford dropout often compared to Steve Jobs. The company boasted famous board directors, including 2 former secretaries of state, George Shultz and Henry Kissinger, as well as future Defense Secretary James Mattis. But Theranos' successes started to unravel at the end of 2015, when the Wall Street Journal published the first of a series of stories illuminating problems with its blood testing technology. CEO Holmes doubled down.
This is what happens when you work to change things, and first they think you're crazy, then they fight you, and then all of a sudden you change the world.
But the trouble continued, with multiple government investigations opened into the company. In May of 2016, Theranos said it voided 2 years of blood test results. In July of that year, the Centers for Medicare and Medicaid Services banned Holmes from owning or operating clinical labs for 2 years. The company was said to be near bankruptcy by the end of 2017, before it secured a $100 million loan. And today, a settlement with the Securities and Exchange Commission, where Theranos and Holmes neither admit nor deny fraud charges. The SEC wouldn't comment on whether other agencies may be pursuing a criminal case. For Nightly Business Report, I'm Meg Terrell.
Signet beats estimates, but the stock falls, and that's where we begin tonight's market focus. A rise in profit and revenue at the owner of Kay and Zales Jewelers was overshadowed by a weak full-year outlook and the announcement of a new restructuring plan. The company said over the next 3 years it will cut costs and improve its e-commerce platform to drive its growth. The shares lost their luster, so to speak, falling 20% to $38.22. The clothing retailer Express reported overall revenue and profits that topped expectations, helped by strength in online sales and outlet stores. Same-store sales, however, fell more than analysts were expecting. Shares of Express fell a penny to $7.39.
Walmart is expanding its online grocery delivery service to about 100 metro areas. It now expects to reach more than 40% of the United States. Right now, the service is offered in just 6 markets. Walmart said that it will continue to partner with Uber, by the way, to help deliver those customers' orders. Walmart shares fell nearly 1% today to $87.67. And United Health Group is reportedly no longer interested in acquiring all or part of Envision Healthcare. Bloomberg says that United Health was at one point potentially interested in working with private equity firms on a deal for the healthcare company. United Health Group shares fell a fraction today to $225.38. Shares of Envision were down more than 7% at $39.41.
United Airlines is under fire again for a dog which died after a flight attendant made the owner put that dog in the overhead bin. The company has since apologized, but is poor corporate culture at the company perhaps to blame? Eric Gordon joins us. He is a professor at the University of Michigan's Ross School of Business. Welcome back, Eric. Nice to see you again. You know,
hello, Sue.
These two airlines, United and Continental, merged a number of years ago. But the problems that those two, and now one airline, they really haven't disappeared. And you think culture might be the key. Why?
Yeah, I think culture is the problem. Here's why. You can't manage everything. You can't have a manager on every plane telling the flight attendants what to do. You can't have a manager at every gate telling the gate agent what to do. What you need is a culture which sets norms so that all of the people that you can't manage every minute know what to do. And when crazy things come up that aren't in your rule book, the people just naturally know. It's the culture. They know how to handle it in ways that are right. You have to guess that the United culture is the culture where they've learned to handle just about everything wrong.
But you have to admit, though, Eric, that there is a strange coincidence that it always seems to happen to United Airlines, whether they're dragging a passenger off or the luggage gets lost or the kid gets sent to the wrong place and now the dog has died. Is it bad karma that this airline has, or what's going on here, do you think?
So I think they started off with bad karma, and the karma effect was multiplied by this merger. The merger is complicated. It's two different cultures. They've never gelled. They're spending a lot of time and effort trying to get things like the reservation systems combined. What they haven't spent time on is improving the culture. And, you know, it's run by a CEO who came to United from a freight railroad. Moving lumps of coal in a freight car is different than moving people in airplanes. Bad culture exasperated by this merger that has made everything complicated.
Yes, it certainly has. Eric, thank you. Always nice to see you. Eric Gordon is with the University of Michigan's Ross School of Business.
Coming up, what one state is doing to help fill the gap in retirement savings.
We told you earlier in our program about Ford stock getting upgraded. Well, separately, the automaker is recalling nearly 1.5 million cars because their steering wheels can come off. Ford says the problem may have caused 2 accidents and 1 injury. The affected models are the Ford Fusion and the Lincoln MKZ, years 2014 to 2018.
The CEO of Toys R Us told his employees that the retailer will likely close all of its U.S. stores. The company plans to file liquidation papers this evening in advance of a bankruptcy hearing scheduled for tomorrow. This move threatens up to 33,000 jobs in the coming months.
It is no secret, of course, that Americans need to save more for retirement. But now one state is stepping in to fill the savings gap. Sharon Epperson has the details.
The beers that we have on tap are on the top.
When small business owner Josh Allison decided to go from a career in biology to beer, his focus was crafting the perfect pint. Giving employees a way to save for retirement may have been a goal, but not one Allison was able to brew up on his own.
You spend a lot of time, a lot of energy working with these people, developing relationships, and they become family. And you really want the best for them. You want them to be able to provide for themselves later in life.
Now, thanks to a program that is the first of its kind in the country, employees at Reach Break Brewing are given the chance to save for their future through a state-run retirement plan called Oregon Saves.
We're giving small businesses the same kind of opportunities that some of the larger businesses have. Low-cost savings for employees at no cost to the employers.
About 55 million American workers in the private sector are not offered a 401k plan through their employer. Most of them, 32 million, work at small businesses, which have fewer than 100 employees.
Some may say, why is that a problem? Study after study shows that people are 15 times more likely to be saving for retirement if they're offered access through their employer.
Oregon Saves requires employers who do not offer a 401k to automatically deduct 5% of an employee's wages after taxes and send it to their individual retirement account, or IRA. Workers can contribute a maximum of $5,500 a year. The plan is managed by the state, and workers must opt out if they don't want to participate. But so far, many being given the chance are doing it.
We have about 5,500 people who are actively contributing to their accounts at this point. There are about 20,000 who are somewhere in the process when their pay periods take place. And in the end, we expect that there will be about 1 million people who could potentially participate.
Reach Break's taproom manager, Chris Merle, who's contributing 5% of his wages to his plan, says this is the first time he's saved for retirement.
It's always something that's kind of in the back of your mind, but you always kind of use your youth as an excuse and say, oh, I can just always do that later, and now it's later.
Critics say there is too much paperwork for companies that already offer 401k plans. Yet more states are following Oregon. 7 have enacted legislation for their own retirement plans, with Illinois and California expected to roll out theirs this year. Another 24 states have introduced legislation to start their own retirement plans.
We're hopeful that other states will see the success that Oregon is having in designing and rolling this program out and make similar programs available in their states.
Josh Allison hopes offering a retirement plan will attract the best employees who will help ensure customers keep coming back.
One thing that the savings plan will allow us is people will be able to view this as a long-term career rather than just a stepping stone.
For Nightly Business Report, I'm Sharon Epperson.
Cheers. It was 10 years ago today that Bear Stearns notified the Federal Reserve that it would have to file for bankruptcy protection. The Fed instead tried to limit the damage with an emergency loan, but a few days later, the central bank then told Bear Stearns it was going to have to find a buyer. And one emerged, J.P. Morgan, who offered a paltry $2 a share for the once venerable Wall Street bank. The purchase price was eventually revised slightly higher, but then soon after, the country witnessed the worst financial crisis in generations. It has been a decade. By the way, if the same thing happened today under the new banking rules, the Fed would not be able to make that same emergency loan.
And speaking of that, the Senate is voting tonight on banking legislation. If it passes, it would be a step towards rolling back some of the rules that went into effect following the financial crisis. It's hard to believe it's been 10 years.
It has.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us. We want to remind you this is the time of year your public television station seeks your support.
And I'm Bill Griffith. Thank you very much for that support. Have a great evening. We'll see you tomorrow.